Hey guys, Stockaholics, thank you guys for being here today. Today I'm just posting a conference call from A2 Milk. The reason I'm posting this, and it's a few months old, is because it really gets you to see how the management sees the business and all the different aspects in the business. There's a lot of the moving parts in the business that can be hard to understand, or why the Daigou channel exists, the margins on different aspects of the business. And they're really getting some really heavy pushback from the analysts who are very angry about all the recent downgrades in the call. So I'm going to put some timestamps for various questions these analysts are asking. And if there's anything that you don't understand in the business, I think that this is really a valuable conference call to listen to.
Thank you for standing by and welcome to the A2 Milk Company Limited conference call. All participants are in a listen-only mode. There will be a presentation followed by a question and answer session. If you wish to ask a question, you will need to press the star key followed by the number 1 on your telephone keypad. I would now like to hand the conference over to Ms. Rebecca Culbertson. Please go ahead.
Good afternoon, everyone. Thank you for joining this call at short notice. On the line today, we have our Chief Executive Officer, Jeffrey Babbage, Chief Financial Officer, Ray Strauss, and Peter Nathan, our Chief Executive for Asia Pacific. Jeff will make a few introductory remarks and then we'll take questions. Let me hand over to Jeff.
Well, look, thank you, Rebecca, and good afternoon to everyone, obviously at short notice. Look, firstly, I hope you are keeping well, keeping safe, wherever you are in any market. Look, as you're all aware, just recently this afternoon we released a statement providing an update to our outlook for the first half and for FY21. I'm going to make a few comments relating to that, and as Rebecca said, happy to take some questions. Look, as we've referenced on several occasions this year, we are living and working in unprecedented times due to COVID-19. We called out in our original FY21 outlook statement that we thought COVID-19 could, amongst other things, impact our supply chains, and that several issues were being experienced relating to our infant nutrition business that we had not experienced before. We commented in August that we were seeing softness within retail Daigou. And in September we advised that we'd started to observe additional disruption to the corporate Daigou reseller channel, particularly in consequence of the stage 4 lockdown in Victoria. At that time we believed this to be a single channel logistics issue and were of the view that the impact of the Daigou channel would prove to be temporary, assuming stabilisation of COVID-19 related issues in Australia. At our annual meeting in November, we noted the difficulties this presents to forecasting, and most of you, no doubt on the call, attended that meeting, and you were no doubt mindful of the comments that I made. There has been some improvement in our infant nutrition business in ANZ, and the second quarter, notwithstanding being below our expectation for December, has shown some improvement in infant nutrition generally, and the second quarter is expected to be higher than the first quarter, but the acceleration of the recovery in recent weeks has been slower than we previously expected. So the reality is that our trading performance, as we continue to very closely monitor that, up to and including the month of November year to date, was broadly consistent with our revised outlook position. And it was only when the board came together this week, when we started to review the outlook for December, which was certainly a higher month expectation compared to earlier months, that we saw some softness that we did not previously expect. And obviously, therefore, as a result of that, we needed very quickly to do some work as to the impact of that flowing through into the second half and the outlook that we had. As indicated in the announcement, with the recent sales performance in the Daigou channel not being as strong as previously expected, we now consider that the recovery in this channel through the balance of the fiscal year will also be slower, and this disruption in the Daigou channel is now having a more significant impact in CBEC. As a result, our internal sales forecasts for both the Daigou and CBEC channels for the remainder of FY21 are now materially lower. As we've commented on previously, the Daigou channel plays an important role in stimulating demand across multiple sales channels, including CBEC. We intend to strengthen our focus on reactivating the Daigou channel in the second half. And we have determined, management has determined, a number of initiatives that will be different in the second half compared to the first half. And that will have some impact on, and has had some impact on, our view of sales volumes in the second half. Importantly, our performance in MBS remains very strong, and we anticipate revenue growth in the first half above 40%, which is very pleasing. We continue to record strong underlying brand health metrics, and the performance in our liquid milk business in Australia and the US remains very strong. So look, all of this gives confidence that we can deliver in the second half to the updated outlook that we have provided. Yes, we acknowledge that the number is certainly significantly lower than our expectation previously, and what we would obviously prefer to be seeing in the second half, both ourselves and no doubt you people as shareholders and analysts. So look, Rebecca, that's my introductory comments, and happy to take some questions. As has been noted, in particular myself, Race and Peter are available to take some questions, which we will now do. Thank you.
Thanks, Jeff. We'll open the call up for Q&A. Can those asking questions please limit themselves to 2 questions and then rejoin the queue? Operator, can you please assist with facilitating the Q&A?
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. And if you are on a speakerphone, please pick up the handset to ask your question. Your first question comes from Sean Cousins from JP Morgan. Please go ahead.
Thank you all. I've got 2 questions. First question is around distributor level inventory in the channel. Can you confirm, and this is probably best for Peter Nathan, I think you indicated that there was not an excess inventory issue problem in August. Can you talk about inventory levels for distributors of A2 product in China at the moment? And my second question is just around the confidence about a Daigou recovery. Given the short lifetime value of customers in the category, why is A2 confident that the Daigou channel will recover, and what would happen to volumes and particularly EBITDA margins, given Daigou's higher EBITDA margin, if the Daigou channel didn't recover? Thank you.
Yes, obviously a number of questions there. Yeah, look, firstly with respect to inventory, yes, we still continue to believe that inventory is not excessive. So that still continues to be the case across our channels. So that's certainly consistent. With respect to your question, sorry, the second question, Sean, again was...
just around, yeah, I mean, I'm just curious around, the company has confidence that the Daigou channel will recover. Your customer has a fairly short lifetime duration with your product.
Yeah.
Why do you believe it will happen? And can you sort of confirm that Daigou's higher EBITDA margin? So then what does that do to your business if the Daigou channel doesn't recover, please?
Sure. Okay, so firstly, what we do know that is with the relatively short lifespan of a consumer, in terms of the movement across the 3 stages, or albeit 4 or 5 stages, if they progress longer with the brand, that the role of Daigou is critical. So therefore, what we believe more firmly than ever that in terms of new user recruitment, Daigou, in keeping with sort of the activation that we have at MBS, which includes PP or PG, depending on what you want to phrase it, is very critical in maintaining user recruitment and also ongoing relationship with our brand. Therefore, that really leads us to further our focus on Daigou, understanding that CBEC is less likely to play that role. Hence the fact that we did believe that CBEC may be able to take up more of the slack. We're now of the view that that's not likely. That Daigou is very much the lead channel. We believe that Daigou can grow in keeping, at least with our forecast position, on the basis of getting Daigou margin where we need to be, which is in consequence of stock management and which is consistent with the forecast going forward. With respect to margin, look, the key point we have made consistently is that we're agnostic in terms of gross margin level, which continues to be the case. In terms of the overall investment in our business, we'll continue to invest heavily in the back half in marketing. Certainly a lot more will be in the current numbers reflects a much stronger investment in marketing relative to second half versus first half, a lot of which is in further activating the MBS channel and also investing in brand, but certainly the focus being on consumer activation points within MBS, which has been very successful in driving our business to date. The very strong results you see, we need that to continue, hence the uplift in investment reflected in the numbers in the forecast.
Okay, thank you, Peter.
Sean, if I could just add a couple of points also to what...
Yes, Jeff. Yep.
Yeah, to what Peter said. Look, for all the reasons everyone on the call is aware, this brand was developed through Daigou. We believe we're committed to Daigou. We're not naive to assume that there won't be changes and that channel won't change. And in fact, our business has been responding, for example, to the change that occurred, Peter, between retail Daigou and the development of corporate Daigou, how to manage corporate Daigou, the most recent initiative the team has put in place in respect of how to further incentivise what's happening with the corporate Daigou channel. So look, all I'm saying is we are acknowledging that there will continue to be shifts in what's happening with Daigou. There is an interplay between the Daigou and the CBEC channel. We want to play in both. We want to succeed in both. It's fair to say we need to manage how we do that, acknowledging the interplay between those two channels. And by definition, if we aren't achieving our objectives in Daigou, you would assume that Peter's team and Li Xiao's team will be thinking through the implications for CBEC as a result. And in addition, let's be very clear, a very key initiative of the business, particularly the last couple of years, has been the substantial resources being thrown at growing our China label direct business. I mean, that's an absolute key. And we all acknowledge that we've got a pretty modest share, and that's growing very strongly. We've got a strong team in place. We've got very strong brand metrics. So clearly we're very focused on that proportion of our business also increasing as a component of our infant formula business over time. So look, your point is absolutely valid. It's a very key question. It's one that I respect because in fact you're spot on. And it's something that we're working through on a continual basis. But the reality is we still see the prospect for a rejuvenation of Daigou channel, and a number of the steps we're going to put in place in the second half will be a little different to what we've done in the first half in consequence of that.
Great. Thank you, Jeff, for the additional colour. Thanks.
Thank you. Your next question comes from Chelsea Leadbetter from Forsyth Barr. Please go ahead.
Thanks. Hi team. I guess Peter, if I can just come back to your comment around you don't think there's excessive inventory in the channel. I guess, what do you mean by the word excessive? And I mean, from your perspective, do you think anything has changed in terms of what that inventory looks like that the Daigou are holding at the moment versus, you know, when we spoke a couple of months ago?
No, not at all. As I said, there's definitely not, inventory, or I use the word excessive, or inventory beyond what we would class to be normal levels at this point. That's certainly the case. As we indicated, the reality is that there is a strong interplay between CBEC and Daigou, and the fact of the matter is that the price, we haven't been able to get the pricing level to where we need to for Daigou to drive the incremental volume that we would have required to hit the forecast, and that's largely due to the fact that CBEC, the ratios of CBEC and Daigou are not where they need to be for us to deliver on that. So therefore, as Jeff indicated, there's a very strong interrelationship, and we need to ensure that Daigou remains first and foremost the lead channel. It always has been, but even more so in keeping with past historic numbers. In order that will enable us to bring the entire English label ecosystem up, and CBEC will very much be the follower channel as opposed to the lead channel, and Daigou will be the lead channel, and that's really the key point. But again, I stress, no, there is not excess inventory in Daigou.
Okay, and I guess just maybe expanding a tiny bit, you comment in the release obviously on the market share in mother and baby, but in terms of Daigou and CBEC channels, can you give us some indication of what you think your market share is doing in those channels? Is it down? Is it flat? How should we be thinking about that?
Within the the data points that we actually buy are SmartPath and Nelson, and it's fair to say that our SmartPath data, which we haven't given, all I can say is that it is strong, so it's certainly holding up. Now the difficulty with Daigou, of course, is that there's no data point that can accurately measure what your Daigou share is. But having said that, of the channel, the fact of the matter is that the channel we're probably holding up, but the problem is that the Daigou channel has indeed contracted at this point in time, for the reasons that Jeff articulated. So therefore, overall, we would expect some consumption loss, yes, across the business as a result of the Daigou channel contraction.
Okay, thanks.
Thank you. Your next question comes from Richard Barwick from CLSA. Please go ahead.
Oh, thanks, Jane. Can I just... more questions on the same topic, but when you talk about the interplay between Daigou and CBEC channels, can you just explain exactly what you mean by that interplay, or how that works? So I'd like, if you just give that description a little bit. I just want to try and paraphrase, make sure I'm understanding the sequence of events, or the flow of product, or how it's supposed to be working and perhaps not working.
Yeah, well, look, part of the problem, Richard, is that the CBEC channel is supposed to fulfil just consumer uptake, but in reality we believe that is not always the case, and that some product indeed flows through to trade. Now, the extent to which that happens and is harder to control, particularly with big events, then that can depress Daigou pricing, which is required to drive the overall consumer engagement. So what we would say is that consumer engagement is driven by Daigou, and therefore CBEC is more fulfillment channel in probably upper tier cities, and Daigou is certainly stronger in maintaining consumer engagement and new user recruitment in lower channels, and therefore they do play a linked role, but a different role. But we do believe cross-border e-commerce, there's limitations in getting in driving new user recruitment and overall brand engagement.
Okay, so then if we put that together with the downgrade that you put through today, is it a case that the intention was you knew that the Daigou channel was depressed, so you were trying to transfer those volumes that would have been sold through Daigou to push that through CBEC, but you are getting some growth in CBEC, but it's not nearly enough to make up for the shortfall. Is that a fair way to sort of summarise
Yeah,
the situation?
that is certainly correct, and absolutely correct. And the other part, the other part of the puzzle is indeed, sort of repeating myself, is that we believe that in order to drive CBEC, you indeed need to first drive Daigou. So therefore, because CBEC will follow Daigou, and yeah, clearly, COVID, we were attempting to address it, the shortfall via CBEC while also driving Daigou. We believe that first and foremost, Daigou is a primary channel that we need to engage in. CBEC will indeed follow along.
All right, and just a quick one on MBS. So I think I don't have the number in front of me, but I think the growth rate you were tracking at through MBS across July and August was close enough to 70% growth, and here you are saying you're expecting to finish the half more like 40. So the implication is your second 4 months are growing a lot slower than your first 2 months. What's going on within MBS? Is there anything you can tell us around store numbers? But I guess even if, regardless, it would suggest that your sort of the sales velocity through MBS must have fallen away from where you were tracking.
No, we don't share that analysis, so I'm not exactly sure we're extracting those numbers, but no, we don't share the same view of the data. But yeah, no, we are seeing consistent growth within MBS, as we've indicated, and across a reasonably consistent level. And again, we are driving both new store growth and also same-store sale growth, and continue to invest very heavily behind the channel, as we indicated in the second half, albeit at a stronger level than we did in half one.
If I just jump in there, Richard, I'm not sure where you're getting your 70% from. That's certainly not a number we've indicated. We have certainly we've had good growth year to date in China label, and that is continuing. So,
right, okay, maybe I'll need to double check my numbers. I thought you were talking back at the September update. You gave a number for MBS, which was, or maybe I'm not quite right on 70, but it was much stronger than 40, I thought.
Well, the underlying volume growth is continuing. It has been strong, and it is continuing.
Yeah. Okay. Righto. Thank you, guys.
Thank you. Your next question comes from David Errington from Bank of America. Please go ahead.
Jeff, I've got two questions. Race, you did say that to Richard it was 77% up to August. Now that flows on to my first question, Jeff, and I'm going to apologise up front if I'm appearing rude, but we've been blindsided now by two pretty sudden earnings downgrades, pretty sudden. Are you confident that the information flow, the financial information flow, is being fed through to management efficiently enough so as that you're not blindsided to such a serious degree? And I'm highlighting here that not only the information flow from China coming through the financials, because what you said in September was pretty sudden, and then what you're saying today is pretty sudden. You've got a chairman who resides in London. The board just met this week. Are you guys getting information on a timely basis so that you can be on top of dynamic change that's happening in these markets, so that you can be faster? Because you've got to admit, Jeff, these are two pretty big earnings downgrades that have blindsided clearly not only you, the board, but us in the investment community. So my first question is there the systems in place in A2 from a financial perspective that are satisfactory, that will allow you to be on top of your numbers to avoid these really sudden shocks that we've had, and we've had two in the space of 2 months? And bear aside, you basically gave guidance at the AGM. So this has been huge change. So that's my first question, please.
Look, thanks for that question. And look, it's a very valid question. I think it's absolutely valid that you asked that. What I can say to you, with my knowledge of the business, having been in for a long time, is that the financial information that is coming through is on an accurate and timely basis. You know, can we do better? Well, we have to think about can we do better. But these issues that we're experiencing, primarily in respect of a channel that is such a critical channel to us, David, you know, this is territory we haven't been in before. And, you know, the reality is that it is very difficult in a channel which we all acknowledge, you know, does not have the transparency through the various tiers. And, you know, we can go and one of the things that we're talking about is how can we source additional information through the tiers and into the market to be more timely from that perspective. And that's certainly a key takeaway that I've got and that management is discussing also with the board. We'd prefer not to be in any way blindsiding ourselves and the market. You're absolutely right. Conversely, we are reliant on this important channel. It has these unusual factors in respect of transparency. It's a channel that others have determined that they don't wish to play in, but for the reasons I've mentioned, we've determined it's very important that we do. What I can say to you again, as we discussed in the last call, is that we are working, actively responding to any changes in our financial position as promptly as that information comes available. And that was the situation in September. The position at the annual meeting was that we had no basis at that time on which to consider, within the bounds of materiality, that we should change our forecast for the full year. We did not have a basis on which to do it. I certainly gave a qualification at the annual meeting, if you recall, in respect of uncertainty pertaining to it. And I'm, you know, as disappointed as you are, as disappointed as the board is, as disappointed as management is, as disappointed as everyone on the call. We are where we are. But I'm saying to you that that's a situation we obviously had to caucus and determine. Had we any additional information at the annual meeting, at the time of the annual meeting, to update in respect of that matter? And we didn't. And I can say to you, I'm sitting here looking at our year-to-date position to the end of November, in respect of revenue, very close to the forecast that we did in September, and I can tell you that that the EBITDA is not below that number. So I'm saying to you, however, December was always going to be a big month, and as soon as it became known to us that that was not likely to be achieved through a discussion earlier this week, the board determined we must do some work. We put in place the trading halt, and we acted as promptly as we could in that regard. Now, could we have known earlier about the potential trend occurring for the month of December? That's a valid question that we're asking ourselves. You know, could there have been market data that started to emerge at the end of November that would have assisted that? But it would have been a very limited time for the reasons I mentioned. Look, it's a very, very valid question, and you know, we're asking ourselves internally what more we could do, but I'm satisfied in respect of the financial information. It is more about what you're really asking. It is about the market dynamics, and can we obtain further information more promptly that can inform us moving forward, and that is an issue that we are talking about internally.
Well, thank you for your answer, Jeff, and I really consider, you know, that was a good I really thank you for that respect that you gave that question, because it is a serious issue. My second question is on the margin drop. Now, the question is, are you discounting prices to move volumes? And is that discounting damaging your underlying brand strength that could cause, you know, because A2 is a premium brand, you've guarded it as a premium brand, but is there discounting going on? And given that you know, the Daigou channel and the CBEC channel is under stress, could that discounting damage the A2 brand premiumisation? Because that would be a serious concern as well.
Look, I'll make a couple of comments, and I'd like Peter also to respond, because again, an extremely informed question. Look, the answer is that this brand, for the reasons you mentioned, has been built on premium pricing. We're not going to move away from that. We're not discounting. The only thing that you're aware that we have discussed is that there has been a new form of incentive program put in place that is not about price discounting to further assist in the ongoing restoration of certain activity within corporate Daigou. We are all about maintaining the premium pricing position. You know, that's in the DNA of this company. And by the way, in respect of our EBITDA to sales margin, the issue is, you know, the Daigou business and sales obviously is profitable for us. That's having an impact on the gross margin line, but we are maintaining in our forecast and our outlook moving forward a substantial continuing spend in marketing in support of the business. And you know, as everyone on the call would know, that you know, the easy way to address restoration of an EBITDA to sales would be to take the knife to certain expenses, and we've certainly done a complete review, obviously, of everything pertaining to corporate, as you would expect, but we are maintaining very strong marketing support in the business, particularly in China moving forward. But Peter, you know, very valid question David raised. Could you add to what I've just said?
Yeah, look, I think what we would say is the reason that we have largely, or one of the reasons we've made an announcement in the first place is to actually protect our brand position. So therefore, what we need to do is to ensure that pricing drives upwards. Now, in the Daigou and CBEC market, that's very much a consequence of supply and demand. So therefore, we want to make sure that we bottom out the market to the extent that we need to beyond what we needed in the past to start pricing moving upwards. And that also pertains to events. So, for example, with the if you look at the Double 11 pricing, yeah, that's largely the retailer discounts that themselves, and that the extent to which that occurs is somewhat out of our control, but also can have a dislocating effect on overall market pricing. So therefore, the extent to which we can control inwards inventory, it will help to help support that. But just to reiterate Jeff's comments, we are absolutely committed to maintaining our premium price positioning, and that is consistent with what we have done any event in terms of any funding of promotion.
Okay. Well, thank you, and thank you, Jeff, for answering the question. I really appreciated it. Thank you.
Can I just jump in there and just to correct the comment before, Richard? The team just confirmed you are correct. We did make the comment of 77% for China label. That is correct. That was based on value, which incorporated the exchange rate. The comment I said before is also correct, that the underlying volume is still very strong. What you are seeing is a significant movement in exchange rate because we are quoting value on both these numbers. So sorry for that correction.
Thank you. Your next question comes from Peter Marks from Morgan Stanley. Please go ahead.
Yeah, hi guys. Maybe I'll just clarify that one. So are you saying there that, you know, the underlying volume growth in the MBS channel has been relatively constant through the half, and that initial 76% sales growth was largely driven by FX?
Yeah, we've had very strong underlying sales growth. We were getting the benefit back in whenever we talked earlier in the year, we were getting the benefit of the FX rates, but the underlying volume was and continues to be strong.
Yeah, so there's no material slowdown in the volume growth.
That is correct.
Okay. And then I just wanted to talk about what might happen with the cash generation if the Daigou doesn't return. So the first point on that is, you know, my understanding is the Daigou pay for the product cash up front. So obviously that's good for your working capital. But then you've also my understanding is you've got minimum annual volume commitments. So where are you with those if the Daigou doesn't return? And should we expect to see a big inventory build on the balance sheet at the year end? If you could just talk about the working capital and the risks around those commitments.
So I'm struggling to understand the comment on your minimum volume commitments. We don't have minimum volume commitments. The cash generation of the business continues to be strong. The working capital, you are exactly right, will change because of the payments. The terms of payments of the Daigou are much more favourable. So the working capital will change. However, there will not be a significant reduction in the overall cash generation that doesn't line up to the reduction in revenue.
So just to clarify, the minimum annual volume commitments that you are required to purchase from Synlait, you don't have minimum?
No, we have no take or pay arrangements in the contract with Synlait. We have an arrangement with Synlait where we have some agreed exclusivity for them to supply up to certain volumes, but that does not convert to a commitment on our part to take minimum volumes. And look, the reality is, I've commented before that we were building inventory in consequence of having appropriate cover, both in our own inventory and in conjunction with Synlait. We agreed we would build inventory in case of exposure to factory disruption March, April into May, and that resulted in our inventory building into June and into July. And we are, as I've commented recently and at the annual meeting, again, we are carrying inventory above what we would like, and we are on a program to reduce that progressively during the balance of fiscal 21. Clearly, obviously, our sales downgrade will mean that our purchases from Synlait will be lower in the second half than what they would otherwise have been prior to this announcement, and that's obviously something that we'll need to discuss with Synlait moving forward. They're obviously not aware prior to this afternoon of our market update.
Okay, thanks for that, guys.
Thank you. Your next question comes from Adrian Alban from Jarden. Please go ahead.
Oh, good afternoon, team. Jeff and maybe Peter, given you've obviously taken your time to assess, I guess, the downgrade that you've provided today, can you make some comment, and particularly within the Daigou channel, on the age of stock to the extent you have visibility, and whether you need to buy back stock or whether you can rule out buying back stock or inventory levels, like at this point? Like it seems like you definitely commented on the sales part, but not necessarily if there's any investment required in the company to sort of restore the channel stuff.
Look, there is no assumption nor need to be purchasing inventory back. What I can say to you, as I've indicated, is we need to very carefully manage our own inventory during the next 6-month period. We need to be mindful of the aging of our inventory moving forward, and we'll take the appropriate steps to ensure that that is appropriately managed during the next 6 months.
Yes, the only other comment I'd make is just to reinforce, it's not as though...
Can't quite hear you, Peter. Can't quite hear you, Peter.
Yeah, the other point I'd like to make is just to potentially correct an assumption. It's not as though Daigou sales are going backwards. They are recovering. It's just that they're not as recovering as a faster rate as we had expected. So that would certainly also support the view there is absolutely no need to or intention whatsoever to buy back any trade inventory.
Just to clarify that though, Peter, so you're comfortable that the inventory that's in the channel is of appropriate age. It's just not drawing down the A2 inventory as fast as you'd hoped, and that's the stuff you're watching in terms of the aging.
Exactly.
Okay, and then the second question, just sort of coming back, I know you sort of spent a lot of time at the start around the interplay between CBEC and the Daigou channel, and it sort of feels a little bit of like chicken and egg in terms of how you like effectively structure a margin for the Daigou. But if you've got a CBEC channel, which I suppose with some of the COVID stuff has been sort of matured faster than normal as an industry with the sort of move to online and stuff, and by deduction it probably gets hit with more promotional type activity, and it's harder to move the price up as a category. What sort of specific initiatives is the company undertaking to sort of rebuild the Daigou margin under that sort of context?
Yeah, well, that's really exactly why why you're seeing the forecast that you're seeing in the second half, because we want to further reduce inventory beyond levels which we normally would in the trade.
But I guess, like, just to ask that question more specifically, if the price doesn't go up in the CBEC channel because there's more promotional activities, and you've noted yourselves a couple of times that the CBEC channel is more competitive, and I presume over time some of your smaller Daigou have been burning off anyway in the background. Like, how do you reboot that Daigou trading margin? Like, what are you doing specifically in the second half?
Well, firstly, we'll continue the activities we've run with corporate Daigou, which is a direct margin assistance. But secondly, it is absolutely a function of supply and demand. That's absolutely what interplay is required. Hence, again, the numbers you've seen for the second half, which indicate that's what we're going to do. So that's really the key issue. So
and then, sorry,
straightforward than that.
Not to hog the question a bit longer, but like as you sort of look forward a little bit further than that, like should we kind of have some sort of structural dent to the Daigou channel as a result of that natural maturing of CBEC? Like, yeah, assuming that the sort of the COVID environment normalises, into 22, would that be a reasonable assumption as you know things today and post your recent discussions with the board and your investigations?
We don't, as I indicated probably earlier in the discussion, we do not see CBEC growing as a percentage of our business from a channel perspective. We see probably the reverse. So we see in the future Daigou becoming a larger share than what is at the moment, returning to the sort of ratios that we've experienced in the past, and then CBEC being drawn upwards into that vortex, as opposed to CBEC leading the new user recruitment function.
Okay. Thank you.
Thanks.
Thank you. Your next question comes from Phil Kimber from Evans and Partners. Please go ahead.
Hi guys, just following on with that interplay question. I mean, is what you're really saying is that to maintain an adequate margin for your Daigou channel, and in particular the corporate Daigou channel, because who knows when the retail side will come back, you basically are going to have to restrict demand in the CBEC channel because otherwise there just isn't enough margin in the chain for the Daigous to keep growing and therefore pushing your product. Is that essentially what you're saying?
Well, it's more about being even more aggressive with supply. Is more probably the point. So, which will therefore further reduce any capacity for CBEC to savagely discount pricing beyond what we would like, and therefore that will have a consequent positive impact on Daigou margin.
Right. And just another one, and I know it's obviously topical here in Australia. Have you seen, I'm fully understanding you're a New Zealand company, have you seen any impacts or in the supply chain from any government interference, slowdowns, more checks, anything like that, in the last few months?
Look, I'll answer that, and the answer for our business is no. But clearly, we have a view that it would be much better. The current relationships, geopolitical relationship Australia-China is regrettable. I don't think we're alone in saying that, and that's not saying each country shouldn't have their own values and be respectful about that and so forth. But we've got an important range of people that we do business with in China. We've got very, very good, respectful and, mutually advantageous relationships. Clearly, if things don't improve, that just puts pressure points on that. We're very mindful, in fact, of deepening our relationships with the parties that we do business with in China. As you all know, we've got this long-term relationship with China State Farm, and we talk to them regularly. They have not been concerned about the issue in respect of geopolitics, but we'd all prefer there to be less noise, of course. And we continue to move down a path of wanting to do even more with relationships in China, and that's part of obviously the strategic rationale that sits behind the Mataura Valley acquisition, or part of it, with China Animal Husbandry being involved, and everything that we've been exposed to, the team's been exposed to over recent months in developing communication with them, is that they look a very reputable and very good company that I think we can do good things with in the future. So by definition, we'd prefer things to be better. You said correctly that we are a New Zealand company, and that's important. Obviously, all of the key product going for China label and CBEC goes obviously direct from New Zealand into China. So look, the direct business that we have going from Australia to China realistically is our pretty small fresh milk business coming out of New South Wales, which is not a material part of our business. Peter, I'd like it to be a material part of our business, but you've got to do a bit more work to make it bigger. But realistically, that's not what's impacting our business. At this point of time, we don't see that changing. It is all about the impact of COVID that we've been talking about for some time, and the knock-on effect of that. But we're trying to work through.
That's great. Thanks for going through that.
Thank you. Your next question is from Tamara Willis from Devon. Please go ahead.
Hi guys. Yeah, most of my questions have actually been answered, but specifically just on the recovery of the Daigou channel, I'm just interested in obviously pivoting back more aggressively, but during the last 6 months, with Melbourne closed, domestic brands in China have got a real leap up. I mean, how confident are you can actually, given that resurgence in domestic brands, you can get the Daigou channel, back to where you want it? And just a bit more colour on exactly how you're going to do that, given
sure.
It's been for the 6 to 9 months of softness.
Yeah, look, very good questions. Look, the key thing I think to appreciate is that, yes, domestic brands have undoubtedly grown. Having said that, in MBS we have grown very strongly as well. So we've grown within that within the context of domestic growth. We'd also say that part of the issue for us has been the fact that where we do resonate very strongly in BCD channels with our Daigou business, because of the channel contraction, that's also enabled domestic brands to grow otherwise where they probably wouldn't have. So therefore we are very confident that we're very attractive offering from a value proposition perspective, also from a brand aspiration perspective, with our English label Daigou offering into particularly BCD cities. We just need to reactivate the channel by making sure the margin is such that we can actually penetrate the consumers within those regions. So in that context, yeah, we believe that we would be fare very well against domestics in those channels, or should I say in those city tiers, once the channel is rebooted.
And the only thing I'd add to what Peter said is yeah, we've been acknowledging in certainly in the last 6 months that a number of domestic brands are performing well, and we're trying to learn as much as we can from that. There's no question about that. I think it's acknowledged that generally international brands into China are under pressure. We are coming from a very small base in respect of MBS, but I repeat again, yes, we are an international brand, but we're an international brand that is partnering and deepening our relationships with parties in China. So we're not just you know, we've got a China team, we've got China partners who are helping to take our product in. So I'm just saying we just don't land the product and hope people will take it. We're very much integrating our business within the China market and with the partners that we have been doing business with and want to continue to build new relationships with. And I think that's an important element just to remember in respect of our business model.
Okay, great, thanks.
Thank you. Your next question comes from Sam Teager from Citi. Please go ahead.
Oh, hi Jeff, Peter and Race. Thanks for taking the question. First one, the new FY21 sales guidance is implying a better second half compared to the first half. So I was hoping you can just talk to us about where you're getting the confidence that things will be improving in the second half, because I'm just conscious that a couple of times over this half, you know, it's been indicated by A2 that there's been some green shoots, but from the look of today's announcement, it doesn't look like any of these green shoots have been sustained. And then if you can, it'd be helpful to get the first quarter and second quarter sales split so we can get a sense of the exit run rate to form our own view as to how achievable your new FY21 guidance is.
Look, thanks, Sam. Obviously with the range that we've given in the outlook, at the lower end of the range, it's a pretty modest uplift in the second half than the first half, very modest on what is clearly, you know, a very subdued first half performance. So that's the first point. I think the second thing I'd say, and Peter would add, is that we've given an indication that we are taking a somewhat different approach in certain elements of the business into the second half relative to the first half, that as a consequence will mean our volume in it, because of those decisions, is going to be lower than, in fact, our previous forecast had. That is all about continuing to put in place mechanisms that continue to assist the restoration of the Daigou channel. We have made now much more conservative assumptions in respect of restoration of Daigou in the second half compared to the first half. And you could assume, whilst we're not obviously, Sam, going to give a breakdown of third and fourth quarter, you can assume that we will be conservative with how that program runs out into the second half. I don't know what you'd like to add to that, Peter.
Yeah, so consistent with Jeff's comment, I mean, as you said, Sam, that yeah, there is a growth in the second quarter v first. As I said, we're not giving the detail about, but there is growth on that basis. We're also, as I indicated, investing more in marketing in China in the second half than the first half, particularly in activation points with MBS, which gives us a lot of confidence. And then furthermore, as I indicated, with our new channel reboot strategy and reset strategy in terms of the mix of volume to Daigou v CBEC, that also gives us confidence that will return us to the sort of ratios that we experienced, yeah, when we're at our zenith or our hottest. Then that sort of ratio can reoccur, which will give us the right shape to build to continue an upward trajectory.
Sure.
And Sam, and sorry Sam, what I can add is just to remind you that obviously, as we've called out, second quarter, our second quarter revenue is higher than our first quarter revenue. And what I can say to you is, as I said earlier, what I can say to you is that the December month was going to be a big month and is still a big month relative to the half. So if I can indicate to you that there is a growth coming through, albeit lower than our previous expectations, that is indicating the green shoots, albeit, you know, they're not, you know, that growth is slower than where we expected things to be earlier in the year.
Got it. And then, you know, with the benefit of hindsight, do you think that if A2 had been more innovative when it comes to traditional infant formula, as opposed to just contesting the market with, one product? Do you think the result here might be different?
Well, that's an interesting question. Look, obviously, when a company goes through the challenges that we're going through, of course, you would expect, everyone on the call would expect, rightly so, that we are reviewing every part of the business in respect of positioning and brands, SKUs, go-to-market strategy, and as I mentioned, we've determined to make some changes in respect to how we manage certain things in the second half compared to the first half that will be different. But, at this stage, there is nothing that the marketing team and Peter's team and Li Xiao's team would say that if we had a different, for example, a broader range of SKUs, that the world would have been different for us. That's my understanding. Peter, have you got anything different to say on that?
Yeah, look, I'd certainly support that. We don't believe that the issue that we faced is anything to do with lack of innovation. As I said, we do believe it's genuinely the channel issue as a consequence of COVID. And as I said, we have a plan to sort that through.
Right, thanks.
But I repeat again, Sam. It's a very good question, and as I said, it goes to the nub that all of you guys, ladies, everyone on the call would expect. We need really to continue to assess our business model, the appropriateness of it, notwithstanding, as we've discussed, the great success we've had in it, what needs to change, and be it in consequence of COVID, in respect of other changes in competitive activity. You would expect we should be doing that. We are doing that. We are not rooted in the fact that just because we've been successful in the past, we can't do things differently, or that we don't need to do things differently. And that's certainly something that we are very much exercising time on as we speak.
Great, thanks. And Jeff, can you just confirm when's your last day, and will David be presenting the February result?
Well, I can say that David is joining, and we're looking forward to David joining. And David's been kept informed to the extent he can. By the way, we've been starting to induct him over the last month in particular. When he's had some availability, he was able to visit the Sydney office for the first time, in fact, earlier this week, which was great. And look, I'm talking with David about what he would like me to do to help him as he comes into the business. Clearly, none of us were quite expecting the headwinds. Certainly, he wasn't. We weren't. You weren't. So look, we're working through that. I'm happy to assist whatever's required. I would expect I'll certainly, hopefully, be asked to assist in how the February pack is pulled together. I'm certainly happy to be involved. That's just something we're going to work through with David, and I'm happy to help post that, of course, because I'm as committed as everyone for this company to restore its performance, to restore its credibility as we move forward. So I'm here to help as required.
All right. Thanks, Jeff, and have a good Christmas.
Thanks, mate.
Thank you. Your next question comes from Jonathan Snape from Bell Potter. Please go ahead.
Yeah, thanks. Just two questions if I can. Look, just first one for Race. Looking at your guidance for the second half and also, I guess, some of the delta, can you just talk me through the NZ US dollar and Aussie New Zealand dollar? How much of an influence that's had in terms of your margin expectations and the movement, and kind of, I guess, what you're assuming in the second half? Is it somewhere near where we're at the moment, or have you got your own forecast running in?
Yeah, thanks, Jonathan. Look, the FX has had a bit of an impact for us, of course. The strengthening of the New Zealand dollar has not been kind for us, considering that we have such a large business, even with this decline in Australian dollars. So as part of this forecast, we have increased our New Zealand Aussie dollar rates, which has had an impact into these numbers. So we are more confident now in light of negative conditions. Yeah, negative. Yeah. We are more confident now that the cost is built in. and we don't expect, not that of course we can control this because as you know we do not hedge, but we expect that we are more aligned now with where the market has actually landed on our exchange rate, which to remind you is all about New Zealand and Australia, New Zealand and US, and of course the New Zealand and renminbi, because we're selling across all channels.
Yep, so is it fair to say you're using kind of a spot level for the second half or something different to that?
Yeah, we're fairly, if I look at November spots, we are fairly close to that.
Great. And look, just a follow-up question, and this might be a bit sensitive, so I apologise in advance. I'm just trying to understand the timeline here in terms of how things have played out, because if I go back and look at yourselves and Synlait's guidance statements, for example, I think back at the end of September, you both simultaneously downgraded your expectations around volumes. On the 11th of November, Synlait obviously downgraded their expectations for finished infant volumes, and you're the only customer of theirs, so one would assume that they saw something in your 12-month forecast that made them think that they had to correct their expectations for their business. Then on the 18th of the 11th, you've reconfirmed your guidance, and then a month later you've come out and downgraded it. So I guess what I'm trying to understand is, how did Synlait see something a month ago that you didn't when they're working off your forecast?
I think I'd simply comment on the fact that the thing to bear in mind is also the issue of inventory. Synlait has been progressively being put on notice, as we've been stating, that our inventory peaked in July, and we've been on a program of reducing that inventory, and they have to obviously take that into account. I'm not privy to exactly, obviously, their numbers in respect of what they do. All I can say to you is that I would be expecting that that's the issue that they've been that they were previously responding to. No doubt they will need to. They've gone into a trading halt. They'll need to review their position in respect of their go forward. But they obviously haven't got any more information about us pertaining to this outlook change than, of course, other than what's now been advised to the market.
But as far as I understand, you give them a monthly 12-month forecast, and the third month becomes kind of firm in the order scheduling. So at some point between the 28th of the 9th and the 11th of November, there's been a change in those monthly ordering rates that's caused them to change their guidance statement. So I'm trying to understand how a monthly sales order that goes out 12 months forward can be reflected in one company but not in another, because it would seem that they should be working almost side by side, given you're the ones giving it to them.
Well, we don't work side by side directly. We have our own forecasting activity that we and obviously we communicate obviously very regularly with Synlait. But I do say to you that there is definitely an issue of how certainly for us, how we're managing our inventory that no doubt is impacting on whatever they're saying to the market in respect of their expectations, which obviously I can't comment on.
But you do give them a monthly 12-month forecast?
Oh, we give them, we work to a
roll and that sort of thing.
We're working to obviously an ongoing, rolling, changing forecast, but I repeat again, what we're particularly doing is managing our inventory position, and they've been on notice for some time that we're in a situation of pulling back our inventory, and how they respond to that in their forecast I can't further comment on.
Okay. All right. Thank you.
Thank you. Your next question comes from Nick Ma from Macquarie. Please go ahead.
Hey guys, just a quick one. Within the forecast, has your outlook for China label changed at all?
Our outlook for China label has actually minor increased. So not significant, but it has slightly increased.
Okay, and what's driven the confidence and that kind of holding to increasing for that product line?
I would say two things, and Peter may want to contribute, but we have obviously continually invested heavily in the brand, particularly last year. We stepped up quite a bit. We continue the investment, and we continue to have good distribution expansion in MBS. Peter, you may want to add anything to that?
Yeah, look, and look further Race's comments, and one thing we haven't talked a lot about is still all the brand health metrics are still in a very, very good shape indeed. So we've had just an update this week on core brand health metrics, brand awareness, purchase intention, loyalty scores. All of them are still very, very strong. So that further sort of supports the Daigou channel theory around why the announcement's been made, which further answers your question that the China business is in good shape and is very solid, and we're continuing our program of investing in stores, as I indicated, investing very heavily in marketing activation, which includes obviously PGs, mama classes, etc. And that is driving some nice strong momentum.
Okay, great. Thanks a lot.
Thank you. Your next question comes from Adrian Albon from Jarden. Please go ahead.
Oh, good afternoon, guys. Just, a follow-up question. You've sort of spoken about a lot of sort of internal review of various features and stuff, and particularly at the board level. But if this does prove to be mostly a single channel sort of Daigou issue, admitting there is an interplay with the CBEC, and you do start to get some recovery, did the board give any consideration to changing its stance on the capital management in terms of a buyback? Because obviously, if you are confident that the brand health is still strong, you've got significant cash resource, you're not necessarily dispersing the cash out of the company, but obviously would send quite a strong signal as well.
Yeah, Adrian. So the short answer to that is we do have a capital management framework, and we've talked about that before, that ensuring we have flexibility and we invest behind our growth. As you would expect, there has been a number of discussions with the board about potential buybacks. So the board is taking that under advisement. It is under discussion, but no decisions, of course, are made.
Okay. Thank you.
Thank you. Your next question is from Chris Wang from Yunqi Capital. Please go ahead.
Hello, management. Thank you for spending time on the call. I just want to have a couple questions. They're kind of related. One is that, in your press release, you talk about COVID impact and knockdown effect and things like that. But, between the last two guidances, matter of 2 to 3 months, that hasn't really changed that a lot, in terms of how travel restrictions, how COVID situations happen in China. Can you give us a bit more granularity on, how does that impact this further guidance change? Second question is that the lower of the revenue guidance seems coincidentally to the amount of business your top Daigou corporate, aka Andy, that does with you guys. And is there any truth that Andy has walked or he's no longer doing business with you guys? Can you talk about that as well? Thank you.
Thanks, Peter.
Yeah, well, just firstly responding to the second question, yeah, quite clearly that is absolutely not the case. So I can give you 100% assurance on that. But Andy's business is still very much aligned with our own, and is part of our key strategic platform and business partner moving forward. So yeah, that there is no zero truth in that rumour. But it does underscore the fact that this industry is full of rumours, I think. And look, to answer your first question, and obviously then throw it to Jeff, is look, the COVID issue. What we are saying is that yes, it's not as though the COVID has changed in and of itself. What we are saying is that the business hasn't grown to the extent that we thought it would post-COVID, and also the COVID issue. What it has done is demonstrated the fact that the CBEC channel couldn't deliver us the upside that we thought it could, and therefore, as I said, we're returning to the channel reset and rebalance with Daigou playing the role that it's always done very well for us in new user recruitment and household penetration, and therefore that will require some rebalancing, but COVID certainly highlighted that fact as being, or that dynamic as being indeed the case, which was otherwise untested. Jeff, any other comments on that?
No, I think that's good. Thank you, Peter.
Right. Thank you very much.
Thank you. There are no further questions at this time. I'll now hand back for closing remarks.
Look, thank you. Thank you, everyone. Obviously, we would have preferred all of us to be having a slightly different day than the one we've had today, obviously the disappointment that our performance is not building as we would have liked in the second half is obviously a concern to everyone. I think, however, I do want to say that that management, as I said earlier, continues to reassess what other things we should do. We have made a change, as we indicated, in respect of a number of things we're doing in respect of the business in the second half, and we are optimistic and believe that the range that we've put in place in the new outlook provides the appropriate bookends for how we're going to take the business forward during this next half, with the intention of continuing, if you like, to rebuild the foundation and how we take it forward. I would like to thank you all again for your continued interest in the company, and the questions that you've been raising are very valid, everyone that's been on the call. Can I also say, just for general information, as you're aware, we've also been working on a number of other things in addition to this, and you are aware that our process in undertaking due diligence and negotiating on Mataura Valley Milk has been continuing during recent times, and obviously continuing into December, and we're obviously optimistic of being able to provide a further update on that. We continue to believe that that's an important strategic opportunity should it be able to come together, and notwithstanding the pressure points that we currently have, we in fact think that a number of aspects pertaining to that potential acquisition are even more valid from a strategic viewpoint moving forward. So look, again, thank you all for your time today, and we obviously will be communicating further with you at the time of the first half release, and I look forward to potentially being involved somehow in that process. So thanks, keep well, and we'll talk again.
Thank you. That does conclude the conference for today. Thank you for participating. You may now disconnect.